In this video, I will take a look at your stock ideas, your recommendations that you suggest in the comment section. So I have highlighted 10 comments here, and let's start from the beginning. In case you don't know me and you are new to this YouTube channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 25% per year. And sometimes some good and nice subscribers write some nice comments and suggest stock ideas. And this is my job, to find good stocks for the long term. So I welcome these ideas. And let's start from the beginning. You have this comment from Simple Finance. Great comment, by the way, always very structured. I love it. And he suggests Arch Capital Group. I'm on Guru Focus right now, and yeah, he says, if you'd like an investing idea, perhaps you can look at this stock and see if this type of investment suits your style. I think like we have a somewhat similar investing style, so you may or you may not finding interesting. Okay, let's start from the beginning. I'm on Guru Focus now. Arch Capital Group, market cap of the company $40 billion. This is the stock chart. Okay, so they IPO'd in the 90s and the stock has only gone up and to the right. I suspect improving fundamentals. Okay, what do? Arch Capital Group is a Bermuda company which writes insurance and reinsurance with operations in Bermuda, the US, Canada, Europe, Australia, and the UK. Okay. The business operates through 3 underwriting segments: insurance, reinsurance, and mortgage. 2 operating segments: corporate and other. Okay, well, this is an insurance company. The insurance segment provides specialty risk solutions to clients across a variety of industries. The reinsurance segment provides reinsurance services which cover property, catastrophe, property, liability, marine, aviation and space, trade credit and surety, agriculture, accident, life and health, and political risk. The mortgage business provides risk management and risk financing products to the mortgage insurance sectors through platforms in the US, Europe, and Bermuda. Okay, normal insurance company. And I think the sexy part, yes. Okay. The sexy part of the business model is that this is getting more efficient. This is the revenue growth, up and to the right. This is the net income growth. Wow. Quite stable, and then something improved in 2019, and then a big massive improvement in 2023. In terms of the balance sheet, they have some debt. I would need to double check on the debt level because this is a company related to insurance, so maybe Guru Focus does some mistakes with banks, insurance, and they generate some good free cash flow. Let's check the operating cash flow, up and to the right. How beautiful this is. And free cash flow, up and to the right. And yeah, because of a splendid 2023, the return on invested capital, the return on equity here is going through the roof. But let's say they have a return on equity between 10 and 15%. Completely decent company. They do some buybacks. They did some buybacks in 2021, some in 2022, a few percentages, but this is not a pure cannibal. Okay, let me go a little bit deeper. P ratio is around 10 for this one. Price to free cash flow is at 5. Here are the margins: 30%, free cash flow margin at 40%. We are talking about a company that creates a lot of cash, generates a lot of cash. Let me create a new window, stock unlock, and let's go deeper in the numbers. I don't know how deep you want it to be. I don't know. I will find what I can find here. What is the ticker? The ticker is ACGL. ACGL. Here, Arch Capital Group. By the way, I want to check if there are some articles written about the stock. ACG. Yep. There are 3 articles written about the stock. One in 2004. Congrats to somebody who held the stock since for 20 years. And the latest one in 2020. So if you want to do your own due diligence, you know where to find some additional information. You can read these articles and you will know more about the business, but I don't have the time to check this. I want to check the financials of the business. What is this business about? Let me put my face here in small here, and let's look at the income statement for the beginning. So you start from the revenue. That is what happened here. I mean, they did nothing for 10 years, and then everything rebounded. What happened in 2012? A rebound from the great financial crisis, yes, but what happened in terms of revenue? Because it seems like the growth has picked up recently, accelerated. Okay, and now there are all-time highs for revenue. Okay, claim loss, policy, expenses. Okay, everything follows the revenue. Pre-tax income, yeah, income is going through the roof, and net income is going. What is that? You have a cyclical company, net income company. Net income is quite cyclical. The net income did nothing for a few years, for 15 years actually, and then went for the stars. My subscribers, I will ask you some questions. What happened here? What has the business model changed here in 2018? So that's funny. And as we've seen, they did some buybacks here and there, and the number of shares almost cut by 40%, something like this. And the earnings per share is obviously going up strongly because of buybacks and a huge net income. What happened in 2023 that caused this big spike in net income? I don't know. Here is the balance sheet. Let me check if I see any major red flags. No, not necessarily. Not necessarily. Everything is going up strongly. They have more debt. They took on more debt recently, and long-term investments, insurance receivables here going, everything is going exponential here. What about the cash flow? I mean, the net income is quite strange. I mean, look at this. You see the same thing that I see. The net income has not moved a lot for 15 years, and now everything picks up. What about the DNA? Whoa. We have a change of 50 million in DNA. Okay, no, that's not very significant. What about the working capital? Not very significant. We are talking, not very significant. Okay, that boosts your net income. I'm thinking out loud if I can see some interesting stuff for you. This is the capex. They don't have much capex. They have almost no capex. Okay, very well. And they pay a tiny dividend. What's the dividend yield on this one? They pay a dividend of. There is no dividend yield. It's as if they didn't pay a dividend. It's so small. And they did some buybacks here and there, but no major issue. And look at this. This is the free cash flow. Yeah, I mean, they follow net income. What I can check here? No, they don't pay a dividend. What I can check for the free form on Stock Unlock that I recommend you use. In case you don't use Stock Unlock, use it. I mean, it's great. And you can use a link. I have this in my description to have a discount. I think you will pay 15% less. What I want to check is revenue, EBIT, net income, EPS. You have a revenue CAGR since 2004, so for 20 years that has grown 9% per year. That's the revenue. EBIT 13%, net income 15%, EPS 19%. So the EPS is growing double digits, and I believe the stock price follows. I will check the valuation after this. That's just a quick look. Stock price adjusted. You have the stock price. Yeah, EPS grew 19%. Stock price grew 17%. So you have a very similar performance. Okay, and I believe compared to 20 years, valuation came down a little bit. What can we see? 20 years ago, wow, what is happening? The PE ratio for this company has always been very low. Sometimes you have PE ratio of 5, and then it went up to 10. I mean, how would you value a company that is not growing? I would not put a valuation multiple of 10 for a company that is not growing. And as we've seen before, net income was flat for 15 years. So I understand the low multiple. And now that growth is picking up, they deserve the better multiple, 2025, and then went back to debt territory with a P ratio of 6. But the company is still growing. If I take a look on the quarterly basis, what is happening, you see that net income is still strong. I believe they sold one of their divisions here. You have maybe a one-off event that created this jump in net income. Most of the time when you see this jump, this is a, how do you say it, a one-off event. They sell one of their division. Revenue still going strong. That's funny. That's funny. Yeah, I will do some due diligence on this one. I will continue to do some due diligence. It seems like they can still generate some healthy free cash flow margins, and you have a low P ratio on this one. You piqued my curiosity. Good comment. Price to free cash flow. So this is not extraordinary what we have right now. So the stock is not a very good buy right now. This is not a one-off event. I mean, the stock has had a price to free cash flow of 5 since 2020. This is not recent at all. Why does it have a discount? What happened? I mean, in the past they had a price to free cash flow of 9. Do they have a discount because they are based in Bermuda and this is not very liquid? What is the bear case on this one? I have many questions actually. Okay. Interesting. Good pick. Good pick. Let's move on to the next one. But thanks for the recommendation. Okay, next one. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. Dr. Gaimin Grival 8140. Keep up the good work. Your content is extremely valuable and refreshing. Thank you very much. That's the goal of this YouTube channel. Could you please make a video about the French company Equasens? It looks like a high quality compounder and your expertise would be extremely valuable. To be honest, I've seen this ticker, I've seen this company Equasens, but I've never taken the time to analyze it. So let's take a look. I'm not a fan of French equities, to be honest. We have a lot of small caps, mid caps, but a lot of our companies, French companies, are struggling. And maybe this is the case for this one. Okay, IPO in 2001. Is this a tech company? What do they do? What do they do? Equasens is engaged in the European healthcare sector. Out of my circle of competence. I'm out. You have my clear answer. This is out of my circle of competence. Providing software solutions. Yeah, software solutions in the healthcare sector. What do I know about software companies for pharmacists? What do I know? Okay, let's continue with some numbers and see if we like it. Obviously, the gross margins are really high. Guys, this is a software business. So obviously, the margins are high. Operating margins are quite low. I get this is a one-off event maybe. Net margins, free cash flow margins around 20%. What do we have? Let's check the revenue. Slightly increasing. I like it. It's a double in 10 years. That's what? Double in 10 years by the rule of 72. That's what? 7% per year. 7% growth of revenue per year. It's a pass. I mean, I can find better than this. Net income went from 14 to 47. That's still decent. Still decent. We are talking about double-digit growth in net income. I like it. And what about the operating cash flow? Up and to the right. Love it. From 10 to 60. I like it. Same thing for the operating cash flow, I suppose. I mean, this is a company that should generate a lot of free cash flow. So it's normal. The free cash flow went from 10 to 40. And they took on more debt since 2016. What is happening? I have a question for you. Maybe you are French. What happened in 2016? Why do they have more debt now? I mean, they don't need more debt. This is a software asset-light business model. But it seems like something changed in 2016 because the return on invested capital decreased and they became a little bit less efficient. Maybe this is a link with debt. What happened in 2016? That would be my main question for you. They do some buybacks here and there, but nothing big. No dilution, no buybacks. Let's look at the share price 2016. What happened here? And what happened since 2021? I mean, the stock price is crashing. Maybe the market is expecting something. What about the fundamentals? Are they deteriorating? Let's look at the revenue. Revenue is stable. Net income is stable. Wow. Free cash flow is non-existent. What is happening? I mean, free cash flow was still there a few quarters ago. What is happening with this stock? Let me check. Maybe Value Investor Club could be useful here. Equasens. No. Equasens. Let me check on Stock Unlock if we can find something, but I will not spend a lot of time on this one. This is way out of my circle of competence. What do I know about software? A software for the healthcare industry. I don't know anything about this one. If you look at the financials, let's take a look. Let's start from the income statement. Let's see what we find. Let's see on a quarterly basis. Yeah. Revenue. I mean, maybe they announced something for their guidance and they expect a slower growth. Let's look at the valuation, by the way. PE of 13. They expect the forward P ratio to be 14. So they expect the earnings to be down in 2025. So maybe I suppose that one of the reasons why the stock is still crashing is because of a bad guidance. Maybe it's because of a macro event. Maybe because of regulation. Maybe because of normal headwind. Headwinds for the industry. Maybe competition, regulation. It could be anything. Macro. It could be anything. Gross profits, interest expenses. Yeah, you have to pay down your debt. They have to pay down your debt, so this is a burden to net income. Income tax expense here. Oh, okay, I see. Net income is still going strongly. I mean, you have here still going smoothly, strongly, and they don't do major buybacks nor dilutions. EPS is still going strong. What is happening to this stock? I know I won't invest in this one because that's out of my circle of competence. I don't know what can disrupt the business. But still, what is happening to the stock? Inventory, no. Piling up, no. Property, plant, equipment. Do they need more capex? What happened here? Did they do an acquisition in 2019? I suppose that's the goodwill. Did they do an acquisition recently because of high property, plant, equipment? That's a major jump. Current debt, they took on more debt. I mean, for what reason? Did they do an acquisition in the latest years, financed by debt, and the synergies didn't occur? Maybe that's the case. But yeah, again, more debt. Return earnings, tangible book value. Intangibles have not moved. And working capital here. That's big capex. Wow. Whoa. Okay. That's the capex. That's the investment in property, plant, equipment. That's the capital expenditures, new facilities, new investments in new software, warehouses, facilities, etc. The capex for this company was really low in 2010, 12, 14, and then it went up a lot from minus $3 million to minus $20 million. Is this a big deal? What is the market cap for this one? $700 million. What is the net income we said? Net income on a yearly basis, the net income is $50 million. So on a yearly basis, 15, yeah, that could be up to 15 to $20 million of capex. I mean, almost half of the net income is going to capex. That's quite heavy for a software business. Another question for you is, why do they need the capex? What is happening? I won't elaborate on this video, but you can go to the investor presentation, so you can ask in the annual report, latest earnings calls, and that is what we do in my coaching program. we do this kind of deep dive, but I won't elaborate on this one on the YouTube video because I have other stocks to monitor. But either you do your own due diligence on this one, or you join my coaching program and we do it together. That's a perfectly good point. This is exactly what I teach my students. Do your own due diligence so you don't fall into traps, and analyze the best businesses in the world to generate a great performance for the future. But okay, I see what you mean. Free cash flow is going down slightly. What is happening? Yeah, okay. Why do they generate some negative free cash flow in 2023? I suspect that operating cash flow was nice. I'm almost done with this. Cash from operating activities. Seems like there was some working capital effect here, so the operating cash flow was not that high. You add to this the big capex, and you have this situation of having negative free cash flow. Maybe the market doesn't like it. Maybe the market doesn't like the trend it is going. Maybe the market doesn't like the guidance. Maybe the market doesn't like the industry. Maybe the CEO has done something. Your time to do the work. I gave you some hints. Your time to do the work now. Dr. Gamin Grivel. Okay, third stock. From Hector Campbell, that is a subscriber, that has been a subscriber for a while, so thank you for your support. Hey Christophe, what do you think of this company, Greg's? Have you come across this? Yes, because you know me, I like simple business models. Greg's is a very simple business model based in the UK. The market cap is $3 billion, $4 billion, and let me read what the description is about. It's a UK-based company that is principally engaged in manufacturing, distributing, and retailing bakery goods, sandwiches, drinks, hot dogs under the Greg's brand. The company focuses on the food on the go market. End of the business model. They sell some food and they make some money selling some food, hot dogs. And this has been the case for years and years and years. So very simple business model. You have some trends, consumer sentiment. If people like to have some food, go outside. But it has been a 100 bagger, 50 bagger. I don't know. Since they IPO'd in 1988, it has been a compounder with a lot of cyclicality, but still a compounder. And look at the financials. Look at the revenue. Decent growth, but not that big. Net income growing nicely from 40 million to 140 million. They took on more debt in 2019. I don't know what happened here, so your time to do the work, I guess. But yeah, what happened for the debt here? Free cash flow consistent, and now they start to do some tiny buybacks. The business, I have analyzed it before. It is not, in my taste, becoming very efficient, and I don't think it's a good hedge with an environment with high inflation. And yes, you have 15% return on invested capital, but I'm still not convinced in how they can operate. In other words, I have found better alternatives, better investments. PE ratio between 15 and 20. I mean, if the business was trading at a PE of 7, I would be interested. But the valuation is not that appealing at the moment. So it's an easy pass for me. Yes, it's a good company, simple business model. I mean, they sell food, but the thesis is not very appealing to me. And this is not a business in the US. This is a business in the UK. This market is very tricky for people that are not from the UK. I mean, you have to be familiar with the UK market. This is a business industry that has been struggling. You have some golden stocks, golden goose of the UK economy. But if you look at the FTSE, I mean the equivalent of the S&P 500, but for the FTSE, not a lot of companies in the FTSE are tech, AI. This is mostly community-driven investments, banks, asset-heavy businesses. I don't like this sector at all. And if I can avoid this country, that's even better. But yeah, you can find some decent opportunities here and there. Greg's is not as appealing as I want it to be. Okay, but thank you for your comment. Very well. That's very much welcome. Let me check my messages. Okay. Gevor Gambarchan. And I have not done any rehearsal for your names, sorry. That's in French. Hey Christophe, thanks for this video. What do you think? Can you do the analysis of Threei Group? I think it can be interesting to you. They have shares in the store called Action, mostly. Thanks again. Okay, let's check a Threei Group. Again, that's very similar to Equasens. I have seen the ticker. This is not the first time I go to their financials, but it was a pass, but I don't really remember why. So let's go back to work. It's a company in the UK. Okay. Market cap is $40 billion. Okay. Threei Group is a close-ended investment fund. Oh no, I'm not interested in this kind of investment. Is business? Yeah, private equity. No, I'm not interested in private equity deals, investment funds. I have Brookfield. That's enough for me. I have Brookfield BN ticker symbol in my portfolio. That's enough. I don't want asset management businesses in my portfolio, so that's an easy pass. So obviously margins will be crazy high. It's normal. It's a fund. It's normal. Valuation will be reasonable. Okay, it's normal. And the growth, yeah, they generate a lot of free cash flow. Yes, it's pretty normal. Revenue is equal to net income. They have some strong margins, and yeah, you can't really analyze the data for asset management businesses on growth focus, but it's an easy pass for me. I don't want to touch asset management businesses, especially in the UK. I have Brookfield. This is 15% of my portfolio, and I don't think I can find better alternatives to Brookfield at the moment. So easy pass. Next one from Jesse. Do you think LB, this is the ticker symbol for Landbridge, is still a buy at current prices? If you don't know what Landbridge is, I may do a video about this. I'm hesitating because I'm still studying the business. This is a company that I love, that IPO'd in the summer of 2024. This is a company very similar to Texas Pacific Land, TPL, that I'm a shareholder of, and they own land in Texas, and so it's a hedge against inflation, anything. They own lands in the Permian Basin. They have some deals with private equity, deals with water management services. You have data centers. You have a lot of deals in the pipeline, and this is a business. They have had their earnings report 1 week ago, I guess. 1 week ago, 2 weeks ago, and they delivered 60% growth in EBITDA and 60% growth for all the metrics, basically. And for the guidance for 2025, they plan to do 50% growth. So you have a lot of deals, and it's quite tricky to look at Guru Focus to understand the numbers. You know why? Because they did an IPO recently in 2024, so you have IPO related costs. When you go public, you have to pay some lawyers, you have to pay some free stock options that you give to employees. That's additional cost. So you have one-off events, one-off costs for 2024. So Guru Focus is a complete mess for this one. So I went through the S1, which is the main document for the IPO, went through all the financials, listened to everything I could find on Landbridge and all the shareholders of Landbridge. I have checked all the Google pages for Landbridge. I mean, I typed Landbridge on the internet and checked all the websites that mention the Landbridge. I think I have checked 100% of everything that was written about Landbridge since 4 years. The company was created in 2021. I have checked every interview, every article, every Google article, every how do you say it? I'm blanking. Oh, any Substack, all the comments of Substacks, all the YouTube videos, all the comments of the YouTube videos. I have done a complete due diligence on this one. And the big question for this company is the growth sustainable? Can they continue to grow 50% per year? We don't have much track record. We don't know management really well. This is a good question, and it all depends on your expertise. I know. I'm a shareholder of TPL. I've been a shareholder of Texas Pacific Land for 4 years now. So I know this sector, the royalty sector. I know how powerful it is because I've been monitoring TPL for a while now. And it seems like Landbridge will follow the same trend with higher growth, better growth. So I think the stock is expensive right now, but everybody is pricing in more growth. So it depends of your expectations. Basically, I don't have a clear answer to you. If you think the company will continue to grow many years in the future, you may say that the company is cheap right now. If the company will struggle, maybe it's not cheap. That's my answer. That's my go-to answer. What I'm still struggling to understand, and I'm still studying the stock. Yeah, but definitely a very good stock that you can add to your watchlist. By the way, I know it very well that it is a very good potential to become a 10 bagger, 100 bagger. Not next year, not in 5 years, but in many, many years. The stock has run up a lot since the IPO. I mean, they IPO'd at $17 per share. So yeah, let's say 20. Now it's at 70. So it's more than a triple with 6 months. It's crazy. So yeah, it depends on your growth assumptions. Next one, Dylan Featherstone. Okay, sorry for my French accent. What are your thoughts on S&P Global? I know the stock. I know the company. Too expensive for me. S&P Global. SPGI. The company is very good. You can't kill S&P Global. Up and to the right, everything goes up and to the right. You have some growth. We are not talking about exponential growth, but we are talking about some good growth, and it's impossible to kill the company. But the TLDR is the valuation is too high. I think they have a P ratio at 45, forward P ratio at 30, price to free cash flow at 30. That's too expensive for me. That's a pass. I just think that yes, it's a great business, but I can find better opportunities. That's my job, to find better opportunities that can generate more than 10%, more than 15% per year. So I think I can find better. I will not elaborate on this one. Next one from Paolo Relvas. I would suggest you to launch a new video on Stellantis and why you believe it's a good investment at these prices. Record low valuation multiples and high cash yield, I guess. Congratulations on your astonishing annual returns. Thank you very much. I started following you after I read your last article in the Stock Unlock newsletter. You provide a lot of value. Thanks. Oh, thank you very much. I write every 2 weeks an article, a newsletter for Stock Unlock. Stock Unlock is a website I use a lot, and I work with Daniel Pronk. So if you don't mind, you can read some newsletter on the internet. We talk about stocks, we talk about the markets, philosophy of great investors. That's really cool. Okay, Stellantis. I have discussed Stellantis on my video of my complete review of my portfolio. So you know my point about Stellantis. I think they have had issues. Why can't I put Stellantis? Okay, they have had issues with inventory inflation in North America for a while, and seems like management is not panicking but struggling even more. So everybody knew that they had some problems in the past, but the stock went up, and now that the problems materialized, the stock is going down. I don't think it's a major issue at the moment. They have a strong dividend yield of 12%. They have some cash in the balance sheet. The company still has the potential to improve their margins, their efficiency in the future. I think most of their problems are short term. This is not the first time a cyclical industry is cyclical and is having a downturn, but I kind of lost conviction with the management that kept their guidance in the past, saying that they will produce free cash flow for 2024, and now they changed their guidance, and instead of generating 5 to 10% of free cash flow, they said, oh no, we will lose the free cash flow, negative free cash flow -5. And I don't like this kind of change in tone for management. And again, when you are a shareholder of this company, always compare your opportunity cost. Talk about your opportunity cost. Think about it. I mean, either you invest in this, in Stellantis, you will have a cyclical business model, and heads or tails if you win or lose, or you can invest in Google, or you can invest in Landbridge. I mean, one of my key opportunity cost, one of my key alternative when I think about stocks is, should I buy Stellantis or should I buy Google? For Google, I'm happy. I believe in the company that will generate more than 10% per year. Can Stellantis generate more than 10% per year? For the moment, they have a high dividend yield and the stock can rebound. They have done this in the past. So there is still potential, but there is room to grow, I would say. So that's my take on Stellantis. I still own it, but I don't know if I will own it in 2025 for the moment. And thank you for your support, Paolo. Okay, next one. Juan Suarez. Do video analyzing Celsius. The message is straight to the point. Thank you for being straightforward. No hi, no please whatsoever. But do the video about analyzing Celsius. You are very lucky. I'm a nice guy, so I will do an analysis you deserve about Celsius. The TLDR is I don't like Celsius. Now you know my point. Now you know where I stand. I hear people on YouTube saying, yeah, Celsius is the best. I read people on Twitter saying, yeah, Celsius is the best. I read a lot of people saying that, yeah, they had a temporary setback, but they will rebound. What I love in the stock market is that you can check the track record for the company. And I don't want to invest in companies that have been unprofitable for years and years and years. Let me scroll down on Guru Focus. Let me scroll down. You have a company, wonderful company, exponential growth for the revenue. If you look at net income, that's a different story. The company has been struggling to make money, and that's just not my investment style. I would have missed Amazon that had the same problem of reinvesting, but that's not my investment style. I won't spend a lot of time thinking about this one. I like easy bets. I'm a simple guy. I want simple stocks. I like Greg's. They sell hot dogs. These kind of simple investments. I like TPL. I like Landbridge. They own lands in Texas. They have zero cost. They produce a lot of earnings. And same thing for the free cash flow. Free cash flow is a mess. And they have become profitable for 1 year, 2 years, and that's it. There is no track record. And now, strangely enough, the stock went for the stars. And in case you don't know Celsius, it's an energy drink company like Red Bull, Monster, this kind of stuff. Okay, that's it. It was supposed to be a loss-weighing company. In their annual report, they said, yeah, if you drink this, you will lose some weight. And then after some regulatory stuff, they remove this sentence from their annual report. So it's not a company that loses your weight, but it's just a pure drink. Energy drink, and they do some marketing for yoga stuff, and they did some marketing for the Jake Paul versus Mike Tyson boxing fight, boxing or MMA, or I don't know. I'm not into these kind of sports. I like watching them, but I don't know the rules. Okay, and the stock has been going up and up and up with more revenue, and interest rates were at zero, so you got some free money, no worries at all. And now there is a comeback to a reality. In other words, in 2022, Celsius did a deal with Pepsi to help them distribute their energy drinks cans to a lot of countries, a lot of people. Okay. Celsius recognizes revenue when Pepsi buys from them. So when Pepsi orders a big chunk of tons of cans, Celsius recognizes this as revenue. Okay, but it seems like in the latest quarters, Pepsi has bought a lot of their cans from Celsius, but is struggling to sell them. So they say, you know what? Let us sell your cans first, distribute first, and then we will order from Celsius again. So there is a revenue backdrop, and there is a revenue mismatch, miss. So the revenue went down for Celsius in the latest quarter. The net income was destroyed, minus 30%, and free cash flow is a mess. I mean, is it updated? If I look at the quarterly basis, you will see the data. Look at this. Revenue was going up and up and up and up and up, and then back down. Same thing for the net income. No net income. No profit for this one. no free cash flow. It was a terrible quarter. And they said, yeah, we inventory management, we reorganized the structure. I've checked the earnings calls for the earnings call for the latest earnings report. I didn't like it. I think something is shady, if you want my honest opinion. I mean, it's just too complex for me. It doesn't mean that it won't rebound and go up. It's just not my style of investing. Maybe I'm completely wrong. In 6 months, it grows from $25 to back to $100. It's just too hard for me. It's in my too complex, too hard pile. No worries, it's a pass for me. But if you are interested in this situation, go ahead and do your own due diligence. Okay, let's continue. Jojo, Jojo, I don't know how to pronounce this one. What about AppLovin? Again, thank you for the short message. That's a short message. AppLovin, from what I see, has exploded recently. I don't know the company at all, to be honest. At all. The stock went up like crazy. It went from 10 to 300. I guess valuation will be stretched. What do? AppLovin is a mobile app technology company. It focuses on growing the mobile app ecosystem by enabling the success of mobile app developers. I don't understand what I read. The company's software solutions provide tools for mobile app developers to grow their businesses by automating and optimizing the market monetization of their app. It's a company that helps app developers. I don't know much about this industry, and they IPO'd recently. What is the market cap? $100 billion of market cap. They generate how much of revenue? 3 billion of what? What is this? What is this valuation? You have a price to sales of 30? Let me check. Price to sales of 25. Net income of 300. I mean, did they have some growth? Oh yeah, okay. Now there is a pickup in revenue, net income. Okay, everything seems to be improving recently. That's why the stock went up massively. Okay, I see. The net income is approximately $1 billion. So you have a PE ratio of 100. Out of my circle of competence. I'm out. Valuation is too high. It's an easy pass. They have $3 billion of debt. That's nothing for their market cap. How much cash flow do they generate? They generate $2 billion of free cash flow. That's a price to free cash flow of 50. By any measure, any metric, this is expensive for me. And yes, they are improving their return on invested capital. Yes, they are getting more efficient, but no, I don't like the price action. I don't like the moves. I don't like the valuation. I don't like it. I don't understand the business. It's an easy pass for me. But if you want me to elaborate on this one, please do your own due diligence, and I will be happy to reread some stuff about this company. And the last one, what about Monster Energy? Again, thank you for the short message. Don't hesitate if you have a new recommendation of stocks, but you can say hi before this. That's cool. Monster Energy, I know it very well actually. I know it very well. I almost bought it this year, and it's again in the same industry as Celsius, energy drink. This is Monster. I know the company very well. In my YouTube channel, I have done a few months ago a deep dive on this one. There is a 2-hour video on my YouTube channel. The thumbnail is blue if you want to check, where I analyze Monster, go through the financials, etc. So I won't elaborate on this video. But I love the company. I love that it has been growing for 30 years, profitable for 30 years, absolutely no debt. They are the second leader in this category of energy drinks. You have Red Bull, Monster, and Celsius is getting more market share if they can sustain their market share. And the PE ratio is about 30. So I won't buy it at the moment. It's a little bit too high. What I like for Monster Beverage is that they initiated a dividend lately, buyback program lately, and they didn't know what to do with their cash, and they bought back 5% of their shares. Okay, approximately 5% of their shares. If they transform themselves into a cannibal, and if they start to buy back 5-6% of their outstanding shares every year, I would be very, very interested to be part of the journey. and invest in Monster Energy. But this is not the case at the moment. I have read the latest earnings calls, earnings report. They said demand is soft. They didn't see such a slowdown in demand, such a softness in this market since COVID. You had three main slowdowns for this company: 2008, 2020, and now. Another question for you is, what is happening? What is happening? So yeah, I'm doing some research on this one, by the way. But I'm getting interested in the price is a little bit too high for me at the moment, but I would be glad to buy it if it drops more. So that's it. I hope that was helpful. Thank you for your pick, guys. Thank you for your pick. I always enjoy reading your comments. You have some great comments, and you are always there in the comment section below. So thank you very much. I like to post every day on this YouTube channel, and I like that people like my videos. People seem to like it, and I enjoy talking to you. And I'm very happy to see that more and more people are joining the coaching program through YouTube. Before that, some people knew me from the newsletter, for the eToro public portfolio, from YouTube here and there, but the YouTube channel is getting more traction, so that's good. I'm very happy, and that gives me more incentive to continue in the future. So I'm happy to continue to post. Ask your questions, I will answer them. Put your ticker symbol, and I will analyze your stocks. If you want me to study a specific video to talk about a topic, I will do it. And if you want to work with me, as always, you have my link in the description below. So as always, thank you for your comments, and I wish you a good day. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description, and I'll see you on the other side.